So, welcome to today's edition of Route 664, the Road to Human Kindness, and the home of endowment engineering. And we use endowment engineering to help people create endowments for themselves. An endowment is a pot of capital that produces income, and that what you're producing is endowment income. We want people to learn how to become endowment engineers so that they can create the amount of income that you need to last you for the rest of your life, so you never have to change your lifestyle, and no matter how long you live. That is the objective of the endowment. So endowment engineers are tasked with that. Look at what you have in the form of assets. Look at what your budget is. What is the needs that you have on an annual basis in order to be able to maintain your lifestyle, and then create an endowment from the assets that you have, plus new assets that you'll add over time, and use that to create a lasting endowment income source. So that's the job of the endowment engineer. In that process, the endowment engineer finds ways to reduce the tax liability or the taxes that may be paid. Anytime you make a transaction, the government wants to take a part of that transaction if you've had a profitable run. If you've made money on the asset, if your asset is worth more today than it was when you purchased it, you've created a capital gain. That capital gain is taxable, and the government will take their share of that gain, just as they take a share of the income that you earn when you earn it ordinarily. So the capital gains tax is a very important tax to try to eliminate. And there are ways to eliminate it, several ways to eliminate it in real estate. One of the ways to eliminate it is through a 1031 exchange. And the objective of 1031 exchange is to create a tax-free transaction. My guest today is Dave Foster. Dave has done many 1031 exchanges, knows how to maximize real estate investing returns by taking advantage of wealth building tax strategies. And in a way, he is somewhat like an endowment engineer, but he is in a particular niche. So we're happy to have you join us today, David. How are you?
Thank you. It's great to be here. Yeah, I love the niche that you're doing because of what a mentor once said to me years ago when I was just getting started in this whole thing. He said, "It's not who makes the most money, it's who keeps the most of the money that they made." And that's where true wealth is. So yeah, great to be here. And I'm living right where you guys are.
Good. So the 1031 exchange, as I said, is one of the ways to do it. But take me through a transaction, a 1031 transaction. What is the typical? Let's say, I'll give you an example. The doctor has a medical building that he's owned for 30 years. He's no longer practicing. The building is worth more than he built it for by, let's say, a couple $1 million, and now he wants to change that investment into another form of investment, uh, maybe into another piece of real estate. If he wants to go into another piece of real estate, how would the 1031 exchange help him?
Sure, absolutely. So when something like that happens, and let's use 30 years as a great example. At the end of 30 years, if they've followed a normal financing course, and if they have taken their depreciation benefits in a straight line, then now they have exhausted their ability to take advantage of three of the four prongs of the internal rate of return. They still might be getting appreciation on the asset. They still might be getting some cash flow, but they're no longer getting depreciation as a benefit. That's an annual tax write-off that reduces our tax. And they're no longer getting the amortization of a loan. So when that happens, many times and other things come into play. They're ready to retire, or the building is going to be in need of significant repairs. All of that's taking cash from you. So what they would do is they would sell that building. Now, when they sell the building, there's going to be two components that potentially could really negatively impact them. The first one is the capital gain from the appreciation on the property over years. The second one is that what most people don't realize is that depreciation is a pretend gift from the IRS, and they're going to make you recapture it and pay it back at the end. So they're going to sell that building, and then using a qualified intermediary, someone like us that the IRS requires to guide you through the process, they're going to go buy another property or properties of any type of investment property anywhere in the country. And as long as they purchase at least as much as they sell, they get to indefinitely defer paying all of that capital gain and all of the depreciation recapture.
So what does that actually mean in terms of the individual? The individual's benefiting by not paying the tax. So how does that help them?
Oh man, let's take you back 35 years to my first real estate transaction, where I bought a duplex in Denver. I fixed it up, rented it, later sold it. And my accountant, I thought I did pretty well. My accountant said, "You got to write a $30,000 tax check," because I forgot that I had a silent partner named Uncle Sam. Now, let's take that $30,000 and using that funky little rule of 72, which says if you take 72 and divide that by your interest rate, that tells you how long it takes to double your money. So take $30,000. If I could have made 10% on that money instead of writing the check to the government, I would have doubled that 7 times.
Mhm.
That's real
So
money.
you're losing the value of the tax dollars as a future investment to produce either income or to grow as the capital
Absolutely.
appreciation.
It's a form of what Albert
So,
Einstein called compounding interest.
right. So if so in the case of the doctor who had a $2 million building, he was also suffering from another issue that arises in times of inflation, which is the building started to accelerate in value to a greater extent than his rent would have. And I'm
Very
sure
true.
that happens in a lot of situations. So you're kind of in a position where you could make more money if you sell the building and invest it uh, and not have any rentals to worry about or any maintenance or insurance or taxes, real estate taxes, and so on. Let me put on my endowment engineering professor hat, and let me another process. So there's two, as I understand it. There's another way that most people know about to defer the capital gain, and that would be to sell their property on a installment basis.
That is correct. An installment sale will stretch out the tax bill, but you're going to pay it. So the
Right.
disadvantage there is the 1031 lets you indefinitely defer it. And
Well,
as long as
not
you,
indefinite. Wait, not indefinitely, because it allows you to defer it until you sell the next building.
at which time, if you do a 1031 exchange,
Right.
it will
But
continue
you're staying in the real estate business.
until you decide to retire. And then a couple of things can happen. You can either 1031 into another investment property or several series of properties, and then slowly over time convert those into your primary residences.
You got to
And
explain that. Explain that one
yeah,
again.
that's a beautiful little confluence there. Let's back up a second, talk about the other way to save money on gain from real estate. If you buy a property you're going to live in, you live in it for 2 out of the 5 years prior to selling it. Then, if you're a married individual couple, you get to take the first $500,000 of profit tax free.
Right.
And you can do that every 2 years. So, I mean, by itself, I would tell people that is the epitome of the absolute best investment in real estate you can ever make because you'll do that 8 or 10 times throughout your year. And you can do this once every 2 years.
What is the outcome of that? Isn't it income?
The first $500,000 of profit is tax
No.
free.
No, I understand that, but I'm saying that the reason why, well, when they're investing it in their house, in a home, they're not going to get income from it.
That's correct.
Okay, so when we let's talk about a situation where an individual already has a home. Obviously, they're not going to want to change their home to do that, and they don't want to be in the real estate business any longer. There is another way to do it, and that is using a charitable device, a 664 device. We call it a social security device.
Sure, charitable remainder
And
trust. Yeah.
yeah, and using a charitable remainder trust or a pooled income fund or a charitable gift annuity. And the difference is that the individual at that point doesn't have to have a continuing real estate interest, and they can avoid the tax and get the income from the property. Now, there's a difference between a pooled income fund and a charitable remainder trust in the sense that pooled income funds have higher tax deductions and allow for a greater return on your investment because it's unlimited and not limited by a factor that's included in a child remainder trust. And that's one of the things that we teach in the endowment engineering course is that there are many different ways of using these charitable devices, and there are multiple charitable devices depending on what the situation is. But where you're trying to create an endowment income stream that is the most that you can get, which is one of the things that the reason why you would do a 1031 exchange and stay in the real estate business is because something in the real estate is producing income. I mean, if you have a strip mall, you're getting rents, and those rents are, let's say, X, and now your building is worth more, and you're not getting X plus Y, you're just getting the X. So now you make a 1031 transaction, a transfer, and you end up in another building where you've taken the full value of the first building. Let's say it was $2 million. Now you're putting a 1031 exchange in and having another $2 million building, but that $2 million building is brand new, and now you can charge rents as the new owner of that building that will be commensurate with that 2 million. But the point is, what I'm trying to say is that it's the income. When you talk about rate of return, you're talking about the income that's being produced by the property, the
All
net
of the
income, right?
sources, all of the sources of income, which is not just the cash
Yes.
flow. Let me finish the example because I think you'll see this. So we've got the primary residence exemption. We have the 1031 exchange for investment property. It is perfectly fine to convert property from one of those into the other without creating a taxable event, as long as you own the property. So let's say you're getting ready to retire and you're exactly at the point where endowment engineering starts to look like it's making sense for the next phase of your life. Well, you've got a choice. You could sell that $2 million property and you could invest it in some sort of charitable remainder trust or something, but you're going to end up paying the tax. Or you could buy what will become,
Why would you pay the tax?
because if you sell that property
You don't
without
sell it,
a,
you gift it.
the, you're absolutely right. And in that instance, the charitable organization is going to receive the benefit of that tax. So it's not going to cost
Well,
you tax.
no, that's not correct. When you put it into a charitable remainder trust, you still maintain control
Yes,
of the property and you get the income from the property. But at the end of the day, when the trust ends at your death, that property would go to charity.
correct. That's exactly right.
Right.
So if you 1031, as the saying goes, and swap until you drop, then your heirs get that property and they get it at what is called a step up in basis. So all of the tax disappears. You don't pay it. Your estate doesn't pay it. Your heirs don't pay it. So there is, in the case where there are potential heirs,
Yeah, but
there's some,
the property, one more point. The property that you own, the new property that you own, that's producing income. What is the rate of return that you get on that property? Uh, and what is it based on?
that depends what you're going to buy. And it depends where you're at in the real estate cycle, depends where you're at in your personal life journey. That's, yeah, it's not an easy question, but take me further. Where are you trying to go with that?
Well, it has a lot of if you own rental property that you're, I mean, the reason why you're getting revenue, how do you get revenue from real estate if you don't have tenants, let's say?
Amortization of a loan, cash flow is part of it,
Yeah, but
depreciation,
where's the
tax
cash flow?
benefit,
Where does the cash flow come from?
if there's cash flow. The four
Yeah.
components of the internal rate of return
Yes, I
are cash.
understand them. I understand that, but where do you get where do you get the income from if there's no rental?
Number one, by depreciation. Number two, by appreciation. Number three, by amortization of the loan.
But you can't spend that money. That's not
Right.
livable income.
So let me take you back to this really cool idea that
Okay.
lets you do both. You've got a property that's your primary residence, but it's retirement time. You're probably looking to downsize. You're probably looking to move to a retirement location.
Well, wait. An endowment engineer, just so you're aware of this, endowment engineering is meant to maintain the lifestyle of the individual for the rest of their life.
Yep.
So it doesn't include downsizing and it doesn't include changing their budget. We don't look at retirement the same way. That's why the endowment engineering is so unique.
Okay.
The endowment engineer says to the individual, we want you to be able to continue your lifestyle forever without having to worry about living too long.
Fair enough. I use the word downside because many times people like to get smaller properties. But let's stay with exactly what you're saying. They want to retire. They own a property they live in. They have a $2 million property that's an investment property. If they sell it, they've got to pay tax on it unless they put it into a program like yours. But if they put it into a program like yours, their heirs are going to lose the step up basis if
No,
they
I
would
understand
inherit
that, but
it.
let's say that, I mean, we
So,
don't do, hold
so
it.
let me
I'm
finish it if I
interrupting you. I'm
could.
sorry. I got to interrupt you because we're not doing this in a vacuum. And one of the things that's important about an endowment engineer is the endowment engineer is basically the highest level of financial planner. The highest level financial planner is someone who deals with the entire individual and their family situation. So it's true that that piece of property may not be left to their heirs, but they've left a lot of other properties to their heirs. In other words, it depends on where they are in the game. And
Exactly.
so, yeah. So, David, and this my point to you is that um, we we want we want to try to make folks like you aware of what endowment engineering is in terms of your specialty, because you do have a very important niche in financial planning. When you have a situation where somebody wants to stay in the real estate business, that is their business, and they don't want to pay tax, the 1031 exchange is extremely powerful because it does all the things you say it does. It allows you to do it without a capital gains tax, without paying the tax on the recaptured depreciation, allows you to move to a property of similar value or greater value without there being a tax loss. But the object of the real estate investment after that is that they're going to make income from that. And that's one of the reasons that they're doing it. They're not doing it for a hobby. So we want to make sure that they get the maximum return on their dollar. And if somebody has a piece of property and sells it first and then reinvests it, that's a problem where you're eroding that value by the tax that you pay. And if you have to pay 20 or 25 or 30%, depending on what state you live in, that can be a very significant number of the total sale price. So, for example, if the fellow had $2 million in property, he would pay 600,000 or more in tax, possibly 600 up to 600,000, maybe even more, depending on the state. But he's going to lose that investment power. So he's only got $1.4 million to invest, whereas if he uses a 1031 exchange, he's got $2 million to invest. That's a big difference. And what you said before about compound interest is all very true. So my point in presenting it this way is to try to get you to look at what we're doing as endowment engineers and maybe become an endowment engineer, because what you do is a piece of the endowment engineering process. You're trying to create an endowment. The endowment is the real estate. The real estate whatever the person owns, whatever you own, for example, Dave, is in your endowment fund. And that's what you have to use for your lifetime to produce your income. The government gives you an endowment, they give you a Social Security endowment, but we know a different kind of structure. We invite you to look at our Discovery 664 Academy. We are trying to educate the public about all these things. And one of the courses that we do have that's coming up on ours is a 1031 exchange course, where we're going to be teaching the public what 1031 is so that they can use that in their work. Now, when you specialize in 1031s, you have a specific skill set that makes it easier for people, I assume, right?
Well, yeah, that's the idea, is
Okay.
that we make it a streamlined, easy process for folks. Absolutely.
Anybody who wants to have a 1031 is contemplating a 1031 exchange, how can you help them?
Well, there are certainly any number of strategies. The 1031 is not an end goal. The 1031 is a tool that you use along your way. And depending on where you're at in your life cycle, depending on where the real estate cycle is, you can use the 1031 exchange to start that compounding interest of deferred tax, to continue that through any stage of a real estate cycle, to continue that to any place or any type of investment real estate that you want to go into throughout your entire life. At which time there are opportunities to exit that and never have to pay the tax.
And your role is what?
The qualified intermediary is required by the IRS. So they require that you use the services of an unrelated third party whose sole role is to process the 1031 exchange.
And what does it mean to process a 1031 exchange?
So the 1031 exchange has some very specific regulations that have to be in place. There's a special order in which it must happen. You're not allowed to touch the proceeds. Strangely enough, you're not allowed to have constructive or active control of the money in between the sale and your purchase. So the qualified intermediary, from a technical legal perspective, is involved at the closing of your sale. They hold the proceeds in between, and they're involved at the closing of your purchase.
Okay, so you operate as a trustee in that capacity where you're taking in the property and making all of the transactions occur within the trust.
No, we are taking custody of the proceeds. The activity of our 1031 exchange, most people find, is not any different than anything they normally do. You decide to list a piece of property, hire a realtor, get a contract. We're involved as part of the closing. You then have 45 days to identify your potential property, 180 days to close it. So you go shopping, you find your replacement property, you get it under contract, and then again, we're involved at the closing of the purchase.
When should somebody contact you if they're contemplating a 1031 exchange or the sale of property?
The best time, well, the QI has to be involved prior to the closing of the sale. The best time to get a QI involved is as soon as you're thinking
what are you
about
saying? What is a QI? Qualified
intermediary, correct.
Okay.
The best time is as soon as you start thinking about it, because strategically and logistically, there's so many different paths you can take that it's often good to be able to think through those to decide what's going to be the best course for you.
And somebody who can guide you, who knows what they're doing.
Correct.
And that's Dave Foster.
Well, we hope so.
David is the CEO of the 1031 Investor and located in St. Petersburg, Florida. And we want to thank you very much for joining us today on Route 664, the Road to Human Kindness. This is the home of endowment engineers and home endowment engineering. And we invite you, obviously, to visit visit us on our Discovery 664 Academy site and just take a look at what we're doing there. I think it's very interesting. I think you may want to be an endowment engineer. We think it's a very good profession at this particular time in our country's history. We need to do some things to change things, and that's endowment engineering is the idea is to endow America. That's what we're all about. So thank you again for joining us, Dave.
Thank you.
Have any parting words of wisdom?
Love the idea. Giving doesn't have to just be a sacrifice. You can give and benefit yourself as well.
Great. Thank you very much for joining us.
1031 exchange. That is a powerful tool that can be used. And 1031 is a section of the tax code, just like Section 664. So sometimes we are trying to train people who are in a niche to understand that there are alternatives to their niche that they need to be able to consider. So the job of the endowment engineer is to help the individual who has the problem, the tax problem, and it's a tax problem because it's not a real estate problem per se, it's a tax problem. Using a 1031 exchange is a way to eliminate the tax on the transaction, and the reason why you do that is because there's a tax problem. You don't want to pay the tax. So that is not in a endowment engineering process. That is one of the ways that you can avoid the tax, but you also need to know the other ways to avoid the tax. And I appreciate Dave's time on our program today. Sometimes we get into discussions that get a little bit not argumentative, but we're trying to educate everybody about how this works. And sometimes we have to educate these niche people, these niche professionals, as to what else is available. And that's why we are offering the ambassador courses. Ambassador community is available to you as well. That ambassador community is a way for you to learn about financial planning in general, the rules to follow in financial planning, what you can do, what you can't do, what you need to do in order to make yourself more successful going forward, and to avoid paying tax that you don't need to pay, as well as growing an endowment in the way that you want to grow it. So when we talk about growing an endowment, we're talking about growing the income stream that you're going to have to live on for the rest of your life. And everybody does that. We do it in different ways. A lot of it is accumulated in our asset portfolio, whatever we're accumulating in our what we're growing to produce the income. The essence of those things, the value of those things is what income is it going to produce, because income is what you live on. You don't live on assets, you don't live on wealth, you live on income. Government gives us an income stream, an endowment of income based on Social Security. What you put into Social Security, that determines what you're going to get as an endowment income when you reach retirement age. Social Security is similar to Social Security in that it is the definition of that income stream that we create in the endowment. So the idea is you accumulate asset wealth to produce income. The way you accumulate that asset wealth is to try and do it with the least tax possible. So in the case of real estate, as we do in a 1031 exchange, if you can save those tax dollars, you're not duty bound to pay the most that the law extracts. You have the right and privilege to reduce the taxes as much as legally possible. If you can reduce the tax, you have more to invest. If you have more to invest, you have more income potential. The only thing that we're at odds with 1031 exchange and 664, the difference between 664 using a 664 device and a 1031 device is that a 664 device allows you to not be in the real estate business any longer and still save the tax, but have your money invested in another form of investment. Real estate 1031 exchanges keep you in the real estate business. That is the very practical way of looking at this. If you reach a point where you don't want to be in the real estate business because you don't want to deal with tenants, you don't want to deal with maintenance, you don't want to deal with insurance, you don't want to deal with the taxes, you don't want to deal with all the things that go along with owning a piece of real estate, because it's time for you to move to something else that produces income, then the 1031 exchange is not going to work because you're still in the real estate business. To extricate yourself from that, you can use a 664 device like a pooled income fund or a charitable gift annuity or a charitable remainder trust. And that's what the endowment engineer can help you determine as to which one is best. There are a lot of different types of these devices, and having a knowledge of all of the various nuances of those devices is very important. We want to make sure that it's done properly, whether there should be flip provisions or all the other things that go into these devices. I want to get into the weeds of that. It's just a different way of doing it. Thanks for joining us today, and we'll see you again next week.